I do want to thank you for the opportunity to speak with you all today. The system that we're going to be showing you in some of the data analysis is probably, from what I've seen nationally, is the most robust system for transparency in financial analysis, to really take the information from the financial report in the institution, which for the general population, and many of us, it's difficult to read those charts of accounts and see what really happened. This distills that down. Okay. First of all, we're going to talk about a little bit of background on the CARAT and the financial condition report. Look at some of the key questions we intend to answer with the report, the CARAT system itself, some of the metrics, and then GASB 68, which for those of you that are familiar with that, had a significant impact on the institutions, perhaps not on an operational day-to-day basis, but definitely on a financial reporting and analysis, and we'll be able to show you graphically how that played out. And then we'll show you analysis of some of the key factors, and then summarize and take questions. However, if you have any questions at any time during the presentation, don't hesitate to ask. Okay, the financial condition report is required by General Appropriations Act by rider. We do it every year, and we publish reports available on our website, as is the CARAT system, if you want to go down and look at it. There are 4 key questions in any financial analysis that you seek to ask or seek to answer, and they're here. Do you have enough resources, and are they flexible enough to support the current mission? Is debt managed and structured strategically? Does the performance and asset management, is that supporting the strategic direction? And do operating results indicate the institution is living within its available resources? This is the CARAT system. I want to take a couple minutes to talk about it in depth. I think the bottom bullet really puts it into perspective, that it creates digestible yet detailed information. As we all know, we could plaster these walls with data. The walls, the floors, the ceilings, we could stack it up in the corners, and it wouldn't make a bit of difference, because you just can't use it. It doesn't inform the decision-making process. It doesn't help to reduce executive overload of information, which we all know is a significant threat to the efficient management of any organization. But this creates digestible information. And as any good business intelligence system, it answers the questions ahead of time. And it allows us to remain flexible. It was developed in collaboration with the institutions. And updates are also taken from institutional input. If we get folks like Dr. Anglin call us and go, you know, we'd like this ratio or we'd like that, we can program that in. We, of course, seek consensus on those sorts of things. So we can do that. And it creates indicators, and that's very important. There's very seldom in financial analysis a right-wrong. In fact, almost never is there a right-wrong, because there are so many factors that influence the situation. But it creates indicators, and so it helps to focus inquiry and to stimulate discussion. On the right-hand side is what you would see if you pull up the CARAT website. It's available on our site. And of course, we're going to talk about some of the primary ratios that you see on the right up there under the CARAT. We'll talk about those in a little more detail. But underneath, you know, quite often we get asked the question, well, what does that mean per student? You know, we say, well, what are tax revenues? How much are tax revenues? Well, you know, that's going to create a disparate picture if you look at Dallas versus a small rural community college. So there's really not comparability. But when you bring it into that leveling factor of per student, then we start to get a better picture. And that goes for all those. So you'll see there's an entire section that's just taking these different financial aspects and putting them per full-time student equivalent. And then there are other ratios that at institutional request, and some from us, that we've also developed. You can pull it up longitudinally. So you can pull up every year from 2006 to present. And you can look at it long term. You can pull it up in a variety of formats. This is an incredibly powerful tool that many times when we get asked questions about the financial condition or about community college finance, we direct them to the CARAT system. And we walk them through it and say, take a look at this system, see if you can get your answer there. If not, give us a call back. And more times than not, in fact, very seldom do we get a second call back that says, I didn't have it. They look at it, and if we get anything back, that had everything that we needed. that answer the question. You can look at all the different institutions. You can look at just a few. You can and pick out peer groups, so you can select more than one entry. So there's so many things you can do in the CARAT system. It's a system we're very proud of, and one that we spend a lot of time in ensuring that the data are aligned with financial reports. These are reconciled with the annual financial reports and other data sources that we have. And then I throw in on the university side, we have a thing called sources and uses, which does a lot of this in a little bit different format. So we have a great amount of financial transparency, which is critical. And because through that, you now have trust. You may not like what it says, but you at least can trust the data, knowing that they came from the institution, they're from audited financials, and they're aligned with other reports. So in this case, if you look at the caption bubble on the left, financially capable of successfully carrying out current programs, and then able to carry out intended programs well into the future. Well, what are the two big aspects of any financial analysis are liquidity and solvency. Those are the two questions that we're seeking to answer through these primary metrics. First of all, the composite financial ratio. That's a combination of those that you see in asterisk. I could go into great detail on how those numbers are actually derived, and if any of you would like me to do that, please feel free to see me immediately after this presentation, and I'll go to whatever level of detail you like. However, for the interest of time, we're not going to go greatly deep into the aspects of that. But those are the main ratios. We're going to talk about each of those individually. But before we do that, we have to talk about GASB 68. For those that aren't involved in the financial arena, this has a huge so what factor. Well, perceptually, here's what happened. There's always been an amount of pension liability that was counted on the TRS's financial reports. That got shifted to the institutions with GASB 68. We knew that perceptually, in looking at the data, that was going to have a significant impact. And when I show you these graphs, you'll see that it indeed did have an impact. But a couple points on that. One, many of those are changes in something, whether it's changes in net assets or changes in different things. So we see the big change initially, but over time we anticipate that's going to smooth and we're going to get back into a more relative picture. But understanding that, we calculated the data both in the report and for the presentation today that if GASB 68 didn't exist and with GASB 68. So you can actually have an apples to apples comparison over time as we discuss this. And what will it look like tomorrow? We don't know, but we anticipate that these changes will buffer out over the long run. Well, first of all, the state primary reserve ratio, essentially saying how long can the institution survive without additional assets generated by operating revenue. Well, you can see here's one of the areas. In red is if GASB 68 were not implemented. And by the way, that wasn't optional. We were going to implement GASB 68. That was not us sitting back going, let's do this great thing. It was Government Accounting and Standards Board. That wasn't necessarily the case. You can see that it still dropped some, but above the 14% that we hold as a standard for success. Now, these are statewide numbers. Okay? So even with these changes, the state primary reserve ratio did remain stable. State viability ratio, we see a similar thing. Statewide, we're still meeting the standard overall, but again, GASB 68 had a significant impact. This measure compares the total expendable net assets to certain non-current liabilities. That's why you see such a huge impact there, because as we said, the non-current liabilities previously. This one's kind of striking. Statewide return on net position. Are the institutions financially better off than they were a year ago? Well, this is where we would see a huge difference once those liabilities were transferred onto the books. And indeed, we did. However, if you didn't consider that, community colleges are actually in a better financial position than they were a year ago, looking at an apples-to-apples annual comparison. For the statewide operating margin, that identifies an operating surplus or deficit in a given year. You see no impact. Why? Because it's operating surplus or deficit in a given year. And while we see a drop from previous years, we're well above, the standard here is 0. We're still well above where we'd find a case for a problem. The statewide equity ratio, that measures the capital resources available and ability to borrow. Still incredibly stable. In fact, very stable over time, even with GASB 68 changes. The statewide leverage ratio, no significant impact on that. It's the indication of the amount of debt service the institution can absorb in the future relative to existing resources. So again, we don't see a huge impact on that because it's existing resources. It doesn't have the non-current liabilities included. And again, the standard is less than 2.0. Now, the statewide composite financial index, that's a summary representation of those 4 areas that we looked at previously. And you can see that while the CFI shows below the standard, you can see the large-scale impact that GASB 68 had. Longitudinally speaking and apples to apples, we can see that they're in a better position statewide than we were last year and commensurate with what we've seen in previous years. Another way we look at this is out of all those financial indicators, how many are met? So we see that a large number in blue, that means the number of institutions that met 6 or more indicators. There's a total of 7. Okay? Red is 4 to 5 indicators, and fewer than 3 are in yellow. Fewer than 3 are the point where we do a little supplemental analysis and inquiry with the institutions in the report. And if you pull up the report and read it, you'll be able to see those comments. And many times the institutions, there's a very good reason. For example, we've seen institutions that have undertaken large-scale capital development campaigns. Well, their numbers drop because they've spent a lot of money, they've borrowed a lot of money, their ability to borrow is less because of that, which was all the right things, and it's just simply an indicator. As we said before, they are indicators. They're not right and wrong. It's not good and bad. Okay? It just focuses inquiry. So again, in our report that we publish annually, we ask some of those questions on the front end so the reader can easily see that, okay, that's why. So, first of all, it's an incredibly robust system, and I encourage you to go out and take a look at the system. And look at the different ratios and pull the data up. Really look at it in terms of people. For those of you that are out there in the finance world, you'll look at it and you go, okay, there's no big deal. But for others, imagine you're trying to look at the math behind that and the literally hundreds of data points that occur. And you can get as detailed or as broad as you like, increases the level of transparency, and most of all, it stimulates discussion and fosters inquiry. So, subject to your questions, folks. Sir.
When the liability was transferred to local units as opposed to centralized, that sounded like just an accounting gimmick. It's from here to there. How do you get to the unfunded liability that exists in the state? Is there a masking of information when you transfer out, or is there still a collection that still identifies for the state total liability, and what portion is unfunded?
Well, that was not being able to get into the exact proportionality and all that. It was a combination of, it was discussion. The real proponent was TRS, and we aligned our efforts and the amounts that were shifted from A to B with TRS. I couldn't tell you, out of pocket what those amounts were in their exact proportions, but we did align the two so there wasn't a missing money. So if it wasn't in A, it was in B. And institutions did some supplemental reporting, and TRS had some supplemental sheets. And in fact, TRS was a proponent of several spreadsheets and different communications media to ensure that happened. We took those numbers for this directly off of the numbers as reported to us. And Pam may be able to shed more light because she was at ground zero on it.
Yeah, and I wanted to go a little bit further there. Our CFO had come back and said that we're getting ready to have another GASB hit us that will deal with unfunded portion on ORP. That'll hit us again.
We have not seen the definitive. Oh, optional. Okay, ORP is optional retirement program. You either have pension or you can participate in ORP, which is more like a 401k type situation. Great, gives the user greater flexibility. We've not received definitive guidance on that, so I couldn't speak to it right now, Dr. Anglin. Okay, well, since we have time, we can do a quiz. No. Okay, hey, thank you very much for your time. Enjoy your lunch and the rest of the conference, folks.